Oh boy, this is going to be so much fun. Why? Because we're ready to start our long march, our trek across the beautiful, majestic, scary, dangerous landscape known as stocks. Exciting stocks, sexy stocks, risky stocks. So, dear students, buckle up because here we go. Don't gamble. Take all your savings and buy some good stock and hold it till it goes up. And if it don't go up, don't buy it. Very wise advice from Will Rogers, a celebrated comic humorist of the early 20th century. Question: how do you make a small fortune in the stock market? Answer: start with a large fortune and you can make a small fortune. Yes, folks, we're going to see that stocks are risky, but if we're patient, if we're prudent, if we're long term oriented, the news is good. Stick with us. What are stocks? Well, I hate that term. It's a real unfortunate term. Businesses, corporations, I don't know, businesses. You're investing in an enterprise, a business. Where did the term come from? Common stocks. Actually, that's the real term, common. That's the legal term, common stocks. I know that's even worse, right? I don't want, I want preferred. No, you don't want preferred stocks. Um, it came from the idea that the shareholders were, the investors were shareholders in common. Everybody who had one share had one vote. If you had 10 shares, you have 10 votes. And they started in the 1600s, actually, believe it or not, in the Netherlands. So if you're interested in history, check it out. Stocks are equity financing, and here you'll hear people say, "Are you in equities?" Yeah, I'm in stocks. I'm in equities. It means ownership, right? You're part owner. This enables investors to participate in the profits and growth generated by the business enterprise. But one thing we don't often hear about or think about is that you're a limited liability owner. You can only lose your investment. You bought one share at $100 and it goes down to zero. That's it. You can't lose any more. That's different from a sole proprietorship where you and the business are the same, or a partnership. Yeah, because if you run a sole proprietorship and all of a sudden incur debts above and beyond what your business is able to pay, they're going to come after you. But they can't do that with stocks. That's not how it works. And so you'll find and read about individuals who use the corporate veil to hide assets and try to get around these rules. And every once in a while, you'll read about a court case where they pierced the corporate veil. They were able to prove that this person was using a sham corporation, not to not to be a real enterprise and make money and provide goods and services. No, they were just using it to shield assets. So that's one thing that we want to remember when we invest in stocks. That once we've lost everything, oh well, they can't come after us anymore. But let's talk about the positives, right? Stockholders should have optionally received. I should add optionally, shouldn't I? Dividends, which says optional payments of earnings. Those are distributions, and if you've taken accounting, you maybe have gone through the transactions, the journal entries where the earnings are distributed, and capital gains, which is what most people think of when they think of stocks. They want the price to go up. That's capital appreciation, and of course we can have capital losses. As the value of the business rises, so should your stocks rise. Yes, if the business does well, your stocks should do well. Now, it's not a one for one comparison. Sometimes the business does really well and the stocks don't do that well. And often the business does okay and the stocks explode. So you got to be careful. Contrary to what many people believe and how many people behave, stocks are not simply millions upon millions of worthless pieces of paper. Not anymore. It's all electronic bits now that people trade each day. No, they represent ownership in real businesses. If you own one share of FedEx, when you see that FedEx truck drive by, you can look at the left front tire and that one lug nut, that's yours. Because of course, right? If FedEx is a huge corporation and one share represents a tiny proportion of the ownership, but still, you're a part owner. Slide number 3. Let's take a look at the good news, okay? over the long term of modern finance, the return from the stock market, as measured by something we're going to take a deal with in this chapter in detail. We talked about a little bit in chapters 1 and 2. The Standard & Poor's 500, the 500 largest companies based in the United States. It's actually averaged over 10%, over 11%, about 11% annually for the last 90 years. I tell people 8, 9, 10%. You got to be careful. But in any one year, it is unlikely that the return will be 10 or 11%. It doesn't work that way, right? It's 4%, 17 minus 2, whatever. The return has varied from a high of 53.8% to a low of 43.4%. We saw that distribution graph, that frequency distribution graph back in chapter 1. And of course, 2008 return was almost negative 40%. 2022, what was it, 20-some percent? Yeah. And in any given year, there's been about a 1 in 3 chance or 1 in 4 chance of a down market. Now, of course, it doesn't go 1, 2, 3 up and down. No, it doesn't. It doesn't work that way. From 1982 to 2000, the stock market went in 2 directions, up and way up, and then went down 3 years in a row. So you just don't know. What we tried to beat into you in chapter 1, we're going to continue with that. But again, the news is not bad. In fact, it's pretty good. Because if we revisit that graph that we talked about in chapter 1, we see that stocks have just clobbered everything else. Now, again, this is a logarithmic scale. Their job is to turn an exponential curve into a straight line, and it does a pretty good job. So it makes these little squiggles here look really low, but look really small, but they're not. They're big drops. And in fact, this one drop here in 2022, that's 20-some percent. I forget exactly what it was, 22%? I forget how far or was it 27? I forget. But still, that doesn't look like a big drop, but because it's an exponential curve, it's a logarithmic representation of an exponential curve, it's actually a very big jump. But still, again, the news is good. Stocks have handily beaten bonds, which have done okay. Treasury bills, a substitute, a representation of short-term investments, have beaten inflation, but not by much. And that's why we say that short-term interest rates, we talked about that in chapter 1, are probably going to be coming down pretty soon because they're above the historical rate of about a little over 3%. Well, we'll see. That's why they call it the future. And of course, if we take a longer view, businesses, stocks have just turned $1 into 56 million. But over the last 200 years, that's what happened. Our standard of living, our technology, this was Beethoven's time and the beginning of the Republic. Somebody woke up, if John Quincy Adams or Thomas Jefferson woke up now, they'd just be astounded at what the modern world has become. And we still have a long way to go, folks. There's still a lot of people who are living on $1, $2 a day, and so we have. And this is good. We've said it's good, right? We said because that means they're going to be buying, Pampers and Nike shoes and cell phones and bicycles and the like. So that's why I'm actually very optimistic. Yeah. Okay. But now let's concentrate or let's focus on the fact that it's not a straight line. That logarithmic scale tried to make it look like a straight line, but no. Folks, it's not a straight line. It's very cyclical. So we're going to go back to 1928, and we're going to show rolling 10-year periods. Now, this is not the Standard & Poor's 500. It's another list of stocks called the Dow Jones Industrial Average. But whatever, they're similar. The Standard & Poor's 500 is better, but the Dow Jones is very popular because it's one of the oldest. And so we see, in the Great Depression, we see rolling 10-year periods where you actually lost money. You put in $100 or $1,000 or whatever, and then 10 years later, you had lost money. Yeah, not fun, right? And then we're coming out of the Great Depression, coming out of World War II, and the stock market went in two directions after World War II, up and way up, and almost hit 20% over 10 years. Oh my goodness. Remember, we were shooting for 8, 9, 10%? And what did you hear people say here? Ooh, 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 is it too late to get in? When you hear people say that, when the grocery guy or gal is starting to tell you what stocks he or she is buying, and it's usually we're ready for a crash, and that's exactly what happened. 1960s came along, and the stock market was still going up, but there were rumblings, and we had Vietnam War, civil rights, women's rights, gay rights. And then we had the first oil crisis. The first oil crisis. Some of you, look, you don't believe me. Type it into images.google.com. The first oil crisis or first oil embargo, second oil embargo, and Watergate and Vietnam. And yeah, the stock market took it on the chin. And you had a rolling 10-year period where we almost went negative, but didn't quite go negative. And what did you hear people say here? I hope you're getting, oh, is it too late to get out? Yeah, 72 and 73, 74 were vicious, a vicious bear market. And what was the real problem? All those cultural things and technological things that were happening. No, it was the baby boom generation. It was me and my cohorts and us old folks. Why? Because it was a huge bulge in the demographic landscape of the country. And if you're interested in the demographics, they actually drive economics, folks. And sure enough, all these baby boomers coming of age have got to go out and get jobs and buy cars and refrigerators and housing and shoes. And it was a very difficult time for the economy. And inflation started to pick up, and the Federal Reserve didn't do the best job until along came a gentleman by the name of Paul Volcker and said, Mr. President, that was Jimmy Carter at the time. Yes, we had a president by the name of Jimmy. And said, Mr. President, we can kick inflation, but it's probably going to cost you the presidency in 1980. And he said, no, it's your job. Same thing with Biden doing the same thing. He's saying, look, they have to do their job. I do my job. They have to get inflation under control. And Mr. Volcker was successful, caused the deepest recession, the deepest downturn since the Great Recession, since the Great Depression, which was eclipsed by the 2008 and 9 recession. But we came out of the 1970s with a new technology, computerization, globalization, glasnost, if you remember. Some of you probably weren't even alive yet, but the Soviet Union, that basket case, why would Putin bring it back? I don't know, but that economic basket case started to saying, we got to do something about this. And sure enough, the stock market went in two directions, up and way up. And the 1980s and 1990s, go cell phones and internet and computers and blue skies, productivity gains as far as the eye can see. And the stock market was really overpriced. And what did you hear people say? You know, right? Oh, is it too late to get in? Many of you weren't even alive in 2000, but oh my goodness, was it? We were partying like it's 1990, and the stock market, and then all of a sudden it crashed. The internet bubble burst, and stocks plummeted. Funny, the boring stocks, we don't hear it too much anymore, but the saying was new economy versus old economy stocks. The new economy stocks cratered. The old economy stocks, some of them held up pretty darn well. And then the housing bubble burst in 2008 and 9, and here we have rolling 10-year periods where you had lost money in the stock market. And you know exactly what people said. Oh, is it too late to get out? Yes, that was the time to be putting money in. And so far, look at what we've done. Now, are we going to see the same? I don't think so. Doesn't mean I'm right. Doesn't mean I'm wrong. You don't know. That's why they call it the future. I think it's going to moderate, but we'll see. It could do this again. It could go back down again. I don't know. But I'm optimistic, very optimistic. Of course, if we don't blow ourselves up, die in our own waste, Tsunami, meteorite, earthquake, disco returning. You never know what's going to happen. But so far, so good. I'm optimistic. I don't think it's going to do this again. I don't think it's going to go up to 20% or close to 20% again. But we'll see. We'll see. I'm happy with 7-8%, folks, and 8-9%. I'm in heaven. But that's me. And we're going to see later on, in fact, in the appendix, if you read the appendix of the book, and hopefully sometime this semester we'll have a presentation on the stock selection guide in the investment club, and I can refer you to that. The betterinvesting.org folks, the people who sponsor the investment clubs around the country, they shoot for 15%. Now I've talked to them. In fact, I volunteer. I'm one of the volunteer directors on the Golden West chapter, and I asked him, "Oh yeah, we get about 10%." Okay, but I met one group that was doing 16%. So oh my goodness, good for them. Yeah. So the news is good, right? But we have to be careful. We have to remember that there are times when you hear people say, "Oh, it's too late to get out." And those are usually the times when it's best to invest. It ain't easy, right? As Mr. Warren Buffett says, investing is simple, but it ain't easy. And the emotions are the ain't easy part. Okay, where are we? Slide number 7. Traditionally, close to half of the returns from stocks was from reinvested dividends. People used to expect 4, 5, 6% in dividends alone. This was as much or often more than bonds returned in interest, since stocks were considered much riskier than bonds. So if you go back between 1936 and 2008, stocks were returning 3.8% in dividends alone. Not even the capital gains. We're just talking about the dividends. But what happened in the 1980s and then definitely 1990s is people started yelling at the corporations, "We're not interested in dividends, and we want capital gains. We want you to reinvest that money back into the company. Don't pay it to us." Now, some companies continue to do that. And between 1997 and 2007, the S&P 500 dividend averaged only 1.5%. You see, less than half of what it had over decades. And people gave various reasons. Dividends were taxed at a higher rate. Well, that's not true anymore. People wanted the business to reinvest the earnings for growth. Don't give me the dividends. We want you to grow the company. Stocks were no longer considered riskier than bonds. There were some very high-profile books that came out in the late 90s saying that stocks are not as risky as bonds. And that's when you knew. I knew, folks. I didn't know when. I thought it wasn't going to happen until 2003 or 4. Something happened in 2000. That we were heading for a fall. There was a book that came out called Dow 36,000. Well, since then, the Dow has made it. I knew someday the Dow was going to hit 36,000, but it wasn't going to be in the next couple of years. And sure enough, as soon as that book came out, it was at the end of 1999, beginning of 2000. That's when the downturn happened. Savings accounts were also paying less than 2%. Now they're paying more, but savings accounts had fallen quite a bit. And of course, there's the old people lost track of their senses and bid up the prices. And of course, that happened quite a bit with a lot of the new economy stocks. You've ever heard of CMGI or AOL Online? America Online? You hear that company? Yeah, okay. drcoop.com, theglobe.com, all the .com companies. mp3.com, all those companies are gone. Slide number 8. So let's take a look at the yield on bonds versus the yield on stocks. Going back to 1960, we see that they were pretty close to one another. Remember, 3.8% was what the average was over decades. And bonds were only paying a little bit more, a little over 4%. But then what happened? In the 1970s, inflation started to rear its ugly head, and bond investors wanted more yield because inflation is a bond investor's worst nightmare, apart from the company going default. And so the Federal Reserve Bank, as we said, started ratcheting up interest rates to kill inflation. And at the same time, look what happened with stocks. Because stocks started falling, the dividend yield started falling, and then it spiked because the stock price went down. It's a ratio, and you can play with it. But if the price goes down and the dividend doesn't change, the dividend yield actually goes up. So the dividend yields were in the 5% range for much of the 1970s. So that was a really great time to be investing in stocks. Right, because we know that because that's when the bottom was. And then we see inflation falling and bond yields falling. And we see the stock market exploding in the 1980s and the stock yield falling as people expected fewer dividends and price kept going up until 2000, the peak of the internet bubble, and the S&P 500 hit 1% dividend, the lowest it's ever been. And the stock and bond prices started falling. That's when stocks took it on the chin. But notice 2008 and 9. Right. The stock market collapsed and bond yields collapsed as the Federal Reserve Bank started lowering interest rates to basically zero. And again, that was another great time to buy stocks. But nobody wants to buy stocks because they lost 50%. And then we bouncing along until finally bonds started to be paying hardly anything, 1 or 2% from bonds. Many companies just started loading up on debt because they could finance debt at 1%. Hey, why not? And then, of course, COVID, the stupid microbe, and all the problems we had with that, which spiked inflation, and we see bond yields spike back up. And notice that the yield on stocks is pretty darn low. And according to many people who are dividend hogs like me, I'm a dividend hog, that's not the best sign. It's not the best sign, but I'm really old because I love dividends. And we'll see, dividends don't lie. But what does that mean for the future? Well, I don't know. We'll see. I'm hoping that we moderate. Isn't that hope beyond hope? I don't know. But we'll see. We'll see. As I said, I'm very optimistic, but there's a lot of things that could go wrong. Not with the economy, with everything else in the world, with authoritarianism rising its ugly head around the world, wars, and yeah, who knows? But anyway, the news is good, huh? So far, what do you think? I hope so. Let's continue. The pendulum swings. The bear markets of 2000 to 2002 and 2008 changed investors' perceptions about dividends. We now see investors and companies focusing more and more on dividends, paying more and more attention to dividends. Many companies that never paid dividends in the past are doing so now. The example were the tech companies. In the early 2000s, Microsoft had money coming out of their ears. Now Google and the others, and Amazon, and I'm not sure about Amazon, but Apple, they have Google. They have tons of cash on the books. And Microsoft at the time had $60 billion. Now some of them have more. Microsoft, I think, is one of them. And so they said, okay, let's start paying dividends. And now there's some of the companies that are raising their dividends the fastest, some of the tech companies. And the tax law has changed. The tax law has changed, so the dividends are taxed roughly the same as capital gains, which is a windfall for investors. And most of the investors are fairly wealthy, so it's been a real gift to many wealthy people. And there's a book by the Geraldine Weiss. She passed away a few years ago. It's not the best book, but it's a great title. Dividends Don't Lie. And I didn't even know this. She was she's an interesting lady. She was an interesting lady. She's up here in La Jolla. She had a investment newsletter. Now, lots of people have investment newsletters, but she started in 1966, and she just signed her newsletters G. Weiss. She didn't want anybody to know that she was a woman. And she didn't let on until she was invited to be on a very popular investing show before cable, took over. This was on that incredibly Bolshevik, communist, liberal television network, PBS, called Wall Street Week with Louis Rukeyser, where she revealed that, yes, I'm a woman. But she finally turned it over to her second in command, who I didn't even notice. He's rewritten the book. So I just checked it out of the library. I'll tell you what I think about it. It's probably the same book, but it's called Dividends Still Don't Lie. Very cute. And this quote is attributed to none other than John D. Rockefeller. Rockefeller Plaza in New York. Yeah. You know, the only thing that gives me pleasure is to see my dividends coming in. Now, we don't really know if he said it or not because his neighbor said he said it. But it's still a great quote, right? This is a guy who's worth, millions at the time. A million was like a billion now. And and he said, the only thing that gives me pleasure is to see my dividends coming in. I don't think it's really, he really said that. But, well, maybe, who knows. But it's a great quote. So let us, you probably heard this, right? Bull market versus bear market. But let us put it in writing here and formally describe the bull market versus the bear market. Bull markets are when the investor optimism, rising markets, economic recovery. Bear markets are where the market falls down. It's actually a bear market is defined as a 20% decline. If it only goes down 5, 10, 15%, that's a market correction. Now, where do these terms come from? Most people will tell you, and this is what I tell people because I really don't know because I'm really not that interested. I tried to figure it out for bear market. Bear market sounds pretty strange, but bull market makes sense, right? Bulls charge ahead. They throw their opponents up in the air, right? Because they're up in the air. Bears are more reclusive, and they they paw down. They knock their opponents down with their claws. But it's actually more subtle than that. So take a look at Investopedias, which is actually a pretty good website. But Investopedia, pretty good. I use it a lot, and you'll notice there's lots of links to Investopedia in the website and in Canvas. And so check on their origins of the term bull and bear market. But just know, bull market. We're back in a bull market. Finally, we've had a bear market since 2022. There was a very brief bear market in COVID. Came back, roaring back very quickly. But in 2022, we finally have come back to from the decline to a bull market. So we're back in a bull market right now in the world of United States markets. Okay, congratulations. Okay, now what are the pros and cons of stock ownership? Well, as we said, the pros, the advantages is that it allows you, the little person on the street, to share in the rewards of the business enterprise. They have been the best in financial investment returns over time. I know some of the real estate owners, real estate investors are going to jump up and down and say, but the real estate has done better. Well, relax. We're going to get to that later on. Dividends, capital gains. Very liquid investment, unlike real estate. Very easy to buy and sell. We talked about the limited liability, that you can't lose more than what you put in. And this is one thing we really don't key on, but when you engage in this system, this capitalist system, you are actually you're helping increase the standard of living for everyone on the planet. Now, capitalism might be the worst economic system ever created by humans, except for all the others. It's not perfect. We have a long way to go, and we've got to do something about the inequality. We have to, because it's getting worse, not better. And that's a recipe for danger, folks. And that's when strong men, strong women, authoritarians can come along and start taking advantage of people who've been left out of the gains that have been created by the system. And it's not, I'm not trying to be a liberal, touchy-feely. This is real. This is what happens, folks. This is what happens when you basically leave out a significant portion of your population in the gains of the economy. What are the cons? Well, as we said, they're risky. They're volatile. That's our euphemism for, oh my God, I lost so much money. Oh my goodness. Yeah, well, that's part of the deal here. We know going in. That's why we did that risk versus return, and that's why we showed you these graphs. We know going into investing in stocks that there are going to be times when they're going to fall. But history has told us it's not a guarantee that those are the best times to invest. Of course. And then, of course, there's a lot of corporate and financial industry hanky-panky. And so we'll discuss some of those, some of the scams. We looked at one scam in chapter 1. There are many others. Often we representatives, stockbrokers, whatever you want to call us, the legal term is registered representative or registered investment advisor, sometimes don't always have our clients' interest at heart, and sometimes put our interest above the client's interest. And I apologize on behalf of our industry. There's not that many people who do it, but it happens. So let's take a look at the volatility. Here is the Standard & Poor's 500 for year 2023. And if you just look at the first day of the year and the last day of the year, it looks like you did pretty darn well, right? Whatever it was. 2023 was like, what, 12.5% or so? But wait a minute. You started off with $10,000 and you were afraid to put it in. I don't know. The industry uses $10,000 for some reason. I don't know why. You're afraid to put it in because 2022 was pretty rough. We lost 20. I forget. I got to go back and look. What was it? 27%? I forget. Or 22%. I can't remember. But 2022 was a rough year. So you waited and you see it jump. Ooh, okay. Let's put the money in. Only to fall 10%. And so you take the money out, only to see it rise and fall and rise until, oh my goodness, look how well it's done. It's time to get in, right? Oh, is it too late to go? And then it bang, goes down after a couple of gut-wrenching falls and rises. And then you take the money out in October and you vow never to put money in the stock market again, and then it goes up 10% again. You just don't know. And anybody who tells you they know is just either fooling themselves or trying to fool you. Either one. You will see headlines. Could the market go up 10%? Yeah, it could. Could the market go down 10%? Yeah, it could. Will it? We'll see, right? Will Apple be worth, a lot more next year? Will it be worth a lot less? It's all speculation, and it's all there to sell eyeballs, sell advertising. So just ignore it. And what we're going to find, what we're going to see, what we're going to learn are techniques to allow us to look 3, 4, 5 years in advance and forget about the daily noise. But stick with us, folks. We've got a long way to go until then. Are you excited? I hope so. Go back over and make sure you understand everything in this presentation here, because this is important. Remember, you're going to be the investment guru for your friends and family and colleagues. It is a very important responsibility. You are going to be awesome. You are going to speak with authority. They're going to say, where did you learn this? And you're going to tell them, right? Business 123, Introduction to Investments. Class is free. All the materials are free. Okay, cool. Hey, in our next presentation, we'll take a look at the stock market. Well, it's actually several markets. But we'll look and see where these things are actually traded, how this system works. Okay? And we won't spend a whole lot of time on what are called initial public offerings, because for the vast majority of us, they're really not something we should invest in. But you might be tempted. But we'll learn about what's called the secondary market. That's the real market. That's the stock market where you buy companies that have been around for 100 years or 50 years or whatever. Thank you so much for being in our class, dear students. It's such a great joy and a great honor to have you, and we want you to be awesome. We want you to become rich. We want you to be a role model for your friends, family, and colleagues, and you will. I'm sure of it.